term versus whole life versus IUL. Which, if any, are right for you? Today, we are going to break it down and help you understand the differences. You may have heard financial advisors say, buy term and invest the difference, or whole life is an investment and builds wealth. And now there's indexed universal life, a hybrid option that promises flexibility and potential growth. It can feel overwhelming. Which one actually protects your family and supports your long-term financial goals? In this video, we'll break each policy down in plain English with real stories, real numbers, and clear visual examples so you can make a decision that fits your actual life. Let's start with the simplest option, term life insurance. Term is exactly what it sounds like, temporary coverage. You choose a term, 10, 20, or 30 years. You pay monthly or annual premiums, and if something happens to you during that term, your family receives a death benefit. If you outlive the policy, the coverage simply ends and there's no payout. Think of it like a car warranty that lasts 5 years. You hope you never need it, but if something goes wrong, you're covered. Term is designed to protect your family during your highest risk years, when you have a mortgage, young kids, and your income is critical to the household. Here's the important part. Term doesn't build cash value. The premiums you pay are purely for protection. That's why term is far more affordable than permanent policies. Let's put real numbers to this. For a 35-year-old non-smoker, $500,000 of coverage costs roughly $33 a month for a 20-year term policy versus $440 a month for whole life. That's more than 10 times the cost. Term protects your family for a set period at a low cost. Whole life protects for life and builds cash value, but it comes at a serious price. The question to ask yourself is, do you want affordable protection during your highest need years or lifelong coverage with a savings component built in? Both are valid. It depends on where you are in your financial plan. Here are 3 people for whom term life insurance makes a lot of sense. Scenario 1. You're 30, just bought a house, and your first child is on the way. A 20-year term policy protects your mortgage and your family's income during these critical years at a price that doesn't strain your budget. Scenario 2, a married couple with 2 kids and college savings goals. A 25-year term policy ensures that even if something unexpected happens, the children's education and everyday expenses remain covered. Scenario 3, a small business owner with small business loans or a partnership agreement. Term coverage can protect your business obligations or your partner if something happens to you. Notice a pattern? Term works best when your financial responsibilities are high but temporary. It gives you coverage exactly where you need it most. When your term ends, you have 3 choices. Let it expire, coverage ends, no death benefit going forward. Renew, but premiums increase significantly because you're older, sometimes dramatically. Convert. Many term policies allow you to convert to a permanent policy like whole life without needing a new medical exam. This flexibility is part of why term is so popular. It's affordable right now, with options to change course later if your needs evolve. Now let's talk about whole life insurance. Whole life is permanent. As long as you pay your premiums, coverage lasts your entire life. Your beneficiaries are guaranteed a death benefit when you pass away. No expiration date, no requalifying. Unlike term, part of your premium goes into a cash value account inside your insurance. Think of it like a slowly growing savings account that lives inside your insurance. That cash value grows tax-deferred, and you can borrow against it if needed for emergencies, college tuition, or even to supplement your retirement income. Important: borrowing reduces your death benefit, and if you cancel the policy early, you may lose a portion of the cash value you've accumulated. Here's how the costs change with age, comparing term and whole life side by side for the same $500,000 in coverage. The higher cost of whole life pays for 3 things: lifelong protection, guaranteed cash value growth, and level premiums, meaning your payments won't increase over time even as you age. That stability and predictability has real value for long-term financial planning. Whole life is built for long-term goals. It tends to be a strong fit if you want coverage that never expires, no worrying about renewing or outliving your policy, Want a guaranteed cash value savings component built into your insurance? Have estate planning or legacy goals that require a guaranteed death benefit? Or plan to use the cash value strategically through what's called infinite banking? If your main goal is short-term protection, whole life may be more than you need and more than you want to pay. But if you want peace of mind and predictable, guaranteed long-term growth, it can absolutely make sense. Now let's talk about the hybrid option, Indexed Universal Life, or IUL. IUL is permanent coverage, like whole life, but with a key difference. Your cash value growth is linked to a stock market index, like the S&P 500. If the index grows, your cash value grows, up to a capped amount. If the market falls, your cash value won't drop below a guaranteed floor. That floor is usually set to 0%. So you're not investing in the stock market directly. Your money isn't in stocks, but how much interest your cash value earns is calculated based on the index's performance. The floor protects you from losses. The cap limits your upside. The result, smoother, more predictable growth than direct investing, with permanent life insurance included. IUL offers more growth potential than traditional whole life, but it comes with more moving parts and requires active attention to funding and performance. 3 numbers shape how your IUL cash value grows. First, the floor, usually 0%. This is your protection. If the S&P 500 falls 30%, your cash value stays flat, not negative, 0. Second, the cap, the maximum you can be credited in a given period. If your cap is 10% and the index gains 12%, you're credited 10%. Third, the participation rate, the percentage of the index's gains that count towards your credit. If your participation rate is 80% and the index gains 12%, you track 9.6%. Then the cap is applied on top. Here's a question that comes up a lot. Is it better to buy cheap term life insurance and invest the difference, or pay more for whole life and let the cash value grow? The honest answer is, it depends. Over 20 years, term premiums are low. If you invest the difference in low-cost index funds and stay disciplined, your investments may outpace what builds up inside a whole life policy. But whole life offers something that investing doesn't: slow, predictable, guaranteed growth alongside a guaranteed death benefit. No market volatility, no discipline required to invest separately. For some people, the structure and certainty of whole life is worth the premium difference. For others, the flexibility of term plus independent investing is the better path. The right answer depends on your financial discipline, your risk tolerance, and your long-term goals. Every type of policy has its own common pitfalls. Knowing them in advance can save you thousands. For term, buy enough coverage. And if you think you'll want lifelong coverage later, consider converting before the window closes. For whole life, make sure you fully understand how loans work and commit to the premium long term. Canceling early can result in real financial loss. For IUL, the policy needs to be properly funded and actively managed. An underfunded IUL can lapse, and that eliminates everything you've built. Life insurance doesn't exist in a vacuum. It's one piece of a larger financial plan. Term life insurance covers temporary income needs, protecting your family while you're building wealth, paying off debt, and raising kids. Whole life provides permanent coverage and a guaranteed savings component that can serve estate planning and legacy goals. IUL combines permanent coverage with market-linked growth potential and tax-deferred accumulation, a powerful tool for the right stage of life. The question to ask yourself is, do you want temporary protection, lifelong coverage, or the potential for market-linked growth inside your insurance policy? Most people don't need to choose just one. Many financial plans include a combination, for example, term life now with a smaller whole life or IUL for legacy purposes. The best policy isn't the cheapest or the most complex. It's the one that fits where you are right now and where you're planning to go. Let's bring it all together. Term life insurance, affordable, temporary, simple. The right choice when you need maximum protection at the lowest cost during your highest need years. Whole life insurance, permanent, guaranteed, builds cash value. The right choice when you want lifelong coverage and a stable, predictable savings component. IUL, permanent, flexible, market-linked growth potential. The right choice when you want the upside potential of the stock market with a floor that protects you from losses. There is no one-size-fits-all answer. Your best option depends on your income, your family's needs, and your long-term financial goals. If you want to stop guessing and get a clear picture of which option fits your specific situation, we'd schedule a free 15-minute financial snapshot call with one of our licensed advisors at River Rock Financial. The link is in the description below. We'll walk you through your options and show you what's possible based on your specific goals. Because generational wealth isn't about luck, it's about strategy. And strategy changes everything. Plan today, protect tomorrow, and enjoy peace of mind always.